So stock splits. I do find this interesting. Why? I know people watching us are very smart investors, traders, but for the newer ones, especially happened to me, when you go and see directly the stock price of a share, you sometimes get fooled by that and think that's the real price. But no, you got to take into account stock splits. And we're actually going to see at the end of the presentation what would be the real price without the stock split of the max 7 stocks. So stock splits, what is a stock split? It's when a company increases the number of shares to boost the stock's liquidity. In other words, they mainly do this because the stock price is too high, among other reasons. But the thing is that the number of shares outstanding increase, but a key thing to actually mention is that the company's value or the market cap does not suffer a change. The most common split ratios are 2-for-1 or 3-for-1. Although we're going to have actually the biggest stock split in history, which is going to occur on June 25th of this year, when Chipotle stock has its 50-to-1 stock split. And why do the stock splits occur? The three main reasons is that, first of all, companies issue additional shares to actually gain more liquidity. They make them cheaper for common investors. Also, they make it more appealing for investors. What are the advantages and disadvantages? Well, as we said, it makes the stocks more affordable for investors. They increase liquidity, facilitating trading and potentially narrowing the bid-ask spread. Also renews investors' interest as more investors jump into the stock, especially if it's a more covered stock. And also indicates executive level confidence in the company's future, allowing it for it to grow. What are the disadvantages? It's a expensive process requiring legal oversight. It's no fundamental value creation, only changes share distribution. May attract less desirable investors because now you see more, as the common term used, fishes, investors who are just jumping into the market, into that stock. And also, well, the risk of non-compliance with minimum stock price requirement of public exchanges. Normally, stocks that actually go into a split won't have that problem, but that actually may occur if you can see a downturn on the market. What are the four main takeaways out of stock splits? It's an automatic adjustment. If you were to see a stock split, if you were to have a Chipotle and in the next month you're going to get a stock split, don't need to worry about it. This is going to be automatically handled by your broker. Also, one key thing as well, no impact on taxes. A stock split does not result in taxable income under the current US law, also to count. It's a positive indicator as it's well received generally by investors, as they're going to see a stock split, and generally that means more liquidity, so maybe more buying, and by the end maybe a little bit of a price increase. That's what it's normally taken as. And no change in the company's market cap, so people sometimes believe it actually doubles or even triples depending on the stock split ratio. It doesn't happen. I just want to see the inverse split and its reasons, Julia. There's also a stock split, but you also have an inverse split. Inverse split, it decreases the number of outstanding shares and increases the share price proportionately. It also has no impact on the market cap. The market value of the company has no impact, so it's just the opposite. Why do companies do it? Normally, when you see a reverse stock split, you gotta take it as a warning sign. One of the reasons may be because avoid delisting because maybe the stock price is too cheap and it does not meet the change minimum value for the share, and companies need to actually or artificially increase the share of the price. You also attract new investors as the stock price will actually look more attractive on paper, a little bit more expensive, appeal to certain investors. And also a perception of management. A higher price shares may be perceived as a more valuable by investors. That's why it's key to actually see the past history, in my opinion, of splits or reverse splits. Negative sides of inverse splits, well, it's a sign of trouble, often viewed as a sign of a company struggling, facing financial difficulties. It's a temporary solution to these troubles, maybe actually to avoid the listing, also to reduce the number of actual members on the board meeting. Less shares can actually take the board members out, allowing more control of the company. And investor distrust, it also may lead to decreased investor confidence and increased volatilities. Here I have a comparison of Amazon that has its split on June 6, 2022. They actually had a 20-to-1 stock split. Price of the stock on June 6 was $3,340. After the split, it actually came at $167. It just boosts the stock liquidity. How many people can afford a share of Amazon at $3,340?
Yeah.
Against 167. And to my right, you have Aeromexico. They just made news. That's why I used this as an example, because they're actually going to look to actually enlist in the New York Stock Exchange this week.
Oh, cool.
They're going to get out of a Mexican stock exchange because they say it sucks. And I agree with them. This is a real situation that happened on Aeromexico on March 17th. 5 million to
million to one. Oh my God.
Yeah, the stock of Aeromexico's price was 0.000047. The following day, they had a 5 million to one
That's
reverse
crazy.
split, and that actually, imagine seeing your stock at 0.000047 US dollars. Following day, you see it at $23.5.
Dude, that's kind of bonkers. You know what this reminds me of is like when there's like some random shit coin and someone's like, it just has to go to a penny. And I'm like, do you know what needs to happen for that to go to a penny? This is what, oh God, anyway, that's funny. Yeah.
Just going with the Max 7 splits, Julia. You got here the Magnificent 7. Microsoft has been with the most stock splits in the history of
Wow.
stock splits. Then you get Apple. Meta, Julia, has had no splits to date, and this is a Max 7 split adjusted price.
Holy crap.
You get the current price on the left and the actual price without the stock split. So Apple, with its current price of $190, it would have been a price of actually $42,000
For one share of Apple? Holy crap.
for one share of Apple.
That's crazy.
For Microsoft, without its 9 stock splits, its current price is at $423. Its current price without any split would have been $121,000 US dollars.
Oh my God.
Tesla, $174. Current price $2,600 US dollars without a split. Google, $3,500. Amazon, $44,000. Nvidia, people say Nvidia is expensive. It's almost at $950, a little bit higher than that. Without its splits history, almost $31,000. And Meta, well, no change because they've had actual no splits. Or I like to ask people, do you think Microsoft price can actually double for the coming 5 years? They say, yeah, of course. Microsoft can definitely go to the price of Nvidia, 900 or even higher, whatever.
Sure.
Or Apple, no? Like if Microsoft is trading at 420, why Apple can trade at the same? Well, you got to take into account its market cap, also the split adjusted price, everything. And definitely, I think this is something to take into account, and cool to see, Julia.
Very cool to see.